Yeah, so one of the terms that you've probably heard about out there is serviceability and borrowing power. So on our panel of lenders, there's more than 40 different lenders. Your borrowing power at each of those lenders can be vastly different. Each lender has a calculator, serviceability calculator, that they use to determine what your borrowing power is. Now, there are a number of factors that go into it. Firstly, they look at your the new mortgage. The new mortgage, let's say the rate on the loan is 4%. The bank is going to assess it at 4% plus 3% buffer on top. Now, the banks need to account for future rate rises to ensure that you can afford that. Now, Australian deposit-taking institutions fall under the regulator APRA, and they're required to have that 3% buffer. Now, there are some other lenders, non-bank lenders, that are not ADIs or not deposit-taking institutions, and their rules are a little bit different. Okay. Yeah, so even if the interest rate on your loan is 5%, you have to demonstrate to the bank that you can afford the repayments on that loan, even if it goes up to 8% with that 3% buffer. Also, the banks have to consider your existing debts. So if you have other mortgages, for example, most of the big banks and most lenders are going to look at the rates on those loans as well and also add 3% to them. So the more debt you have, often it becomes harder and harder to borrow more money. But having said that, there are some lenders that are much more generous in those sort of situations. So although your bank may say that you can't borrow the amount, you can't buy that next investment property, there may be lenders out there that can lend you the money for that. Yeah, so some non-bank lenders who don't fall under the regulator APRA may not have the same requirements in terms of buffers and assessment rates. So your borrowing power may be higher, and that's obviously where a broker comes in handy, because we've got access to a lot of those lenders that can assist with lending higher amounts.